For this afternoon, we're going to present the study which we conducted in order to first examine the role and the contribution of the financial services sector in each of the ASEAN member countries. So that would include the banking sector, life and the non-life insurance subsectors, as well as the capital market sector. We also assessed in this study the commitments of the country on the financial services sector under the AFAS framework, as well as the status of the compliance of the country. We analyzed the extent of the Philippine financial services sector's competitiveness in comparison to other ASEAN member states. We did that by looking at the de jure and de facto measures of financial restrictiveness in all of the countries available. And we also estimated, using statistical frontier analysis, average cost and average profit efficiencies of banks where they are available, in order for us to be able to provide recommendations in order to enhance the competitiveness of the country's financial services sector. So, in looking at the economic role and contribution of the banking sector to the financial services sector, we looked at several traditional indicators, such as indicators for the degree of monetization in the economies. The first indicator we looked at is broad money as percent of GDP. And as we see here, Malaysia, Singapore, and Thailand have higher levels of banking development. And the ratio of the Philippines is only higher than those of Indonesia and Myanmar. The second indicator for the banking sector is money supply per capita. And just like in the previous indicator, Singapore is also an outlier in this category. The Philippines fell behind the 5 ASEAN member states, including Vietnam. And looking more closely into the contribution of the banking sector into the economy, we looked at banking assets and deposits as percent of GDP and in per capita terms. In terms of the ratio of banking assets to GDP, we found that the Philippines ranked the 7th, and in terms of banking assets per capita, the Philippines ranked the 6th among the ASEAN member states. And same story can be gleaned from the deposits side. And we see here that the per capita deposits in the country is equivalent to only 1/3 of Thailand's and 1% of Singapore's, Thailand being the next better performer than the Philippines here. We also looked at the degree of financial intermediation in the economies by looking first at the private credit by deposit money banks as percent of GDP. And we see here that for the Philippines, access to credit is much more restricted compared to that of the 7 other ASEAN member countries. And if we also look at the net loans to deposit ratio of the 10 largest banks in each of these countries, we also see that the Philippine banks are not turning over their customer deposits into loans as much as what the other ASEAN member states are doing. And we observe that this is possibly because of the high reserve requirement, although it does not fully explain it. We hypothesize that the presence of the special deposit accounts could also be a factor for that, because these SDAs have acted as a disincentive to banks to exert more effort in looking for qualified borrowers, especially for borrowers among the small and medium enterprises. Now we look at the indicators for the life insurance markets. So, again, looking at assets and premiums, percent of GDP and in per capita terms, we see that Singapore has the largest market both in terms of assets and premiums, and the Philippines has the smallest market. Market penetration for the Philippines is second to the lowest amongst all of these ASEAN member states, and insurance density is at the lowest. And if we look at the non-life insurance market, the same story can be gleaned from the figures. And in fact, we observe that the country seems to be dominated by small companies. And also, when it comes to market penetration and market density, the Philippines seems to be also to rank the lowest amongst all the relevant ASEAN member states. Now, looking at the capital market, looking at the number of listed companies for each of the ASEAN member states, we see that for the Philippines, the number of listed companies has remained fairly the same from 2003 and 2012. And in fact, in 2010, Vietnam has overtaken the country in terms of the number of listed companies. But if we look at the market capitalization of listed companies as in percent of GDP again, we can see here that the Philippines has a relatively high market capitalization, but we have few firms listed in the Philippine Stock Exchange, which suggests that there are a few large firms that participate in our capital market, and that we have few stocks that tend to be highly priced, making our stock market greatly vulnerable to sudden withdrawals. So in summary, what we did was to make an index using the figures for Singapore as a numeraire, and we tried to summarize it in this radial chart. So countries whose charts are inside Singapore are considered to be less financially developed. And as we see here, Philippines, Indonesia, and Vietnam are all less financially developed compared to Singapore. And in fact, it's only in the capital market and in the non-life insurance subsector where other countries have performed better than Singapore. So now we are done with summarizing the economic contribution of the financial sector. So we will now be looking at the compliance of each country with their APAS commitments. So as far as compliance with the APAS commitments is concerned, it's not an issue for the Philippines and for the other ASEAN member states, primarily because what they have put forth are already what's existing in their laws and regulations, which implies that they're not really committing to further liberalizing their financial sectors compared to what is already in existence. But for the purpose of this paper and for policy planning, the more important question is to determine how restrictive are the country's commitments compared to those of the other ASEAN member states. So, if we would recall, the ASEAN member countries view capital account liberalization and financial sector liberalization as two sides for the creation of an integrated financial services market. And a liberalized capital account is meant to support and enhance a liberalized financial sector. So we looked at the de jure and de facto measures of capital openness. The first measure that we looked at is the Chin and Ito Index. So the latest version was in 2011. And this particular index takes on higher values the more open the country is to cross-border capital transactions. You see here that Singapore has the highest degree of capital openness based on this index. And the Philippines has the same degree or level of restrictiveness as Thailand, Malaysia, and Laos. But in actuality, we can see, based on the ratio of total foreign assets and liabilities to GDP, that Singapore is still the most open based on this de facto measurement. The Philippines, however, is less financially integrated with the rest of the world compared to the other ASEAN member states, and possibly because, among other markets for financial instruments in the country and the investment planning, as presented in the slides earlier on market capitalization and the number of listed companies. So we now look at the financial regulatory regime to try to measure the level of restrictiveness. We look at the foreign equity caps to try to capture how open the country is to participation by foreign players. Although we understand that this is only one aspect that captures the degree of restrictiveness, and we will try to touch on the other aspects in later slides. Here we see that, okay, I'll just note that this is what's committed in AFAS, so it does not yet include the recent increase in the equity cap that has been implemented for the country. But we see here that the Philippines is more or less liberal in entertaining foreign players compared to all the other countries except Vietnam. However, we understand also that market entry can be further limited by imposing the requirement that the majority of the board members be nationals. And we also see here that the different countries in the region apply different degrees of restrictiveness when it comes to the equity participation of foreign players. Okay, we now look at a de facto measure for the financial restrictiveness in the countries rather, by looking at the contribution of foreign banks into the ASEAN banking system. The shares of foreign banks in the total deposits is less than 10% in countries like Indonesia, Laos, the Philippines, and Thailand. And foreign banks seem to focus more on wholesale banking, probably because of the limited number of branches they're allowed to establish in the countries where they are operating. You can see here that ASEAN banks still have much room to expand their presence in the Philippines in the near term, while for the Philippine banks, given their financial resources, it might be a challenge for them to penetrate the banking markets in other ASEAN member states. So what we did was to create an index that tried to capture the degree of restrictiveness for the financial subsectors in the countries. And we divided the restrictions into three categories. So we have entry, human resources, and operational restrictions, each of which consists of several sub-items. So again, we used Singapore here as the numeraire. And Singapore still appears to be the least restrictive in terms of entry into the banking system, followed by Vietnam. And the Philippines still has less restrictive commitments in the banking sector compared to Indonesia, Malaysia, and Thailand. And the Philippines and Malaysia still appear to be least restrictive on the operational aspects of their commitments. Okay, so that's for the banking sector. Now, looking at using the same approach to the insurance sector, this is combined life and non-life. We see here that Vietnam still appears to have the least restricted commitments, entry commitments, followed by the Philippines. And with regards to the operational aspects or operational restrictions, the Philippines and Malaysia still has the most restricted commitments. And it should also be noted that both countries put a restriction on the cession of all or a portion of risks to specified insurers. Using the same approach to try to capture the degree of restrictiveness in the capital markets. We see that as far as entry commitments are concerned, the Philippines appears to have the most restrictive commitments for the capital markets. And it should also be noted that so far, only Singapore and Malaysia allow foreign ownership of land, while the Philippines and the other members of the ASEAN still do not allow it. So we summarized the indices for all of the subsectors for each country. And again, using Singapore as the numeraire. And you see here that the Philippines' commitment for the banking sector under AFAS falls under the Goldilocks level of restrictiveness, which is neither too liberal nor too restrictive. And in the insurance subsector, Vietnam's commitments were the least restrictive, followed by the Philippines and Singapore. And in the capital market subsector, Singapore still has the least restrictive commitments, while the Philippines appears to be the most restrictive in the region. So that's for the assessment of the compliance with the AFAS commitments. So we now go to an assessment of the competitiveness of the ASEAN markets and the financial institutions. So we performed descriptive analysis using available data on banks and insurance companies. And we also performed econometric estimates of the cost and profit efficiency of banks using stochastic frontier analysis. For the banking subsector market, looking at the total assets of the top 3 banks and the total deposits of the top 3 banks for each of the major ASEAN member states, we see here that the Philippine banks are among the smallest in the region, because the total assets and deposits of the largest bank in Indonesia and Thailand are roughly twice than those of the largest bank in the Philippines. And the assets and deposits of the largest bank in the Philippines is smaller than those of the smallest banks in Indonesia, Malaysia, and Thailand. And we also did the same for the insurance market. We looked at the total assets of the top domestic life insurance companies and the premiums of the top domestic life insurance companies for the major ASEAN member states. And we glean almost the same story. We're in the largest life insurance companies, their assets and premiums are less than those of the three domestic life insurance companies of Singapore and Thailand. Although the assets and premiums of the largest domestic life insurance company of the Philippines is twice than the assets and premiums of Malaysia's largest domestic life insurance company. And it should also be noted that the largest life insurance company in the Philippines have assets and insurance premiums of less than $1 billion. For the cost and profit efficiency of banks, we used the available data from BankScope of individual banks in the selected ASEAN member states. And we estimated the average cost efficiency and average profit efficiency for each country broken down between domestic and foreign players. For the average cost efficiency, values that are greater than 1 are considered to be cost efficient, while for the average profit efficiency, values less than 1 are considered to be less profit efficient. And we see here that foreign banks are considered more cost and profit efficient than domestic banks in countries like Indonesia, the Philippines, and Vietnam. And also, foreign banks that are profit efficient are also most likely to be cost efficient, although the relationship does not necessarily hold if you look at the domestic banks. And then lastly, what we did was to get the average cost and profit efficiency of the 5 largest domestic banks for each country. And we see here that the Thai banks are found to be the most cost efficient, while the Vietnamese banks are the least cost efficient. And the Indonesian banks appear to be the most profit efficient, while Vietnamese banks are the least profit efficient in the region. While Philippine banks are consistently second to the last in both cost and profit efficiency.